Hey everyone. Despite stock price improvements in 2023, C3AI stock is still down 82% off its high. So, should investors buy C3AI stock for 2024? Artificial intelligence is the most popular investing trend right now. C3AI is in a good position to benefit from that. So, isn't this a no-brainer? Well, let's dig into the details and answer that question in this video.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So I mentioned already that C3AI stock is down 82% off its high here, but in 2023 it's been up from the bottom. So it hit a low here around January of 2023 and it's been bouncing higher, of course, capitalizing on that trend, the popularity of artificial intelligence. C3AI offers enterprises AI solutions that could improve and enhance their productivity, make them increase revenue or decrease expense or improve speeds, operational performance. And it's thought of as a lesser version of Palantir. Palantir is like the premier elite version of offering enterprise and government AI solutions. C3AI is similar, but nowhere near the quality and the performance of Palantir. And so it's trying to emulate that kind of performance and it's making progress, but it's not there yet. It's not in the same league as Palantir. Still, C3AI has done a good job increasing revenue. Here I have a chart of its quarterly revenue increasing from a little over 30 million in 2019 all the way up to 73.23 million in its latest quarter. C3AI recently launched a new AI solution that it's just now testing and piloting with enterprises and receiving contracts and extending and signing contracts and making deals. And it looks like their clients like the platform. It's still really early. They've just launched it. And so we'll really start to see the benefits of this going out into 2024. So let's look at the estimates for C3AI in 2024 and 2025. According to consensus estimates, C3AI is expected to increase revenue by 19.8% in 2024, and that's looking like it's going to increase by 23.6% in 2025. So revenue growth is expected to accelerate for C3AI over the next 2 years from the 14.7% growth rate in its fiscal year 2023. Keep in mind, C3AI's fiscal year ends in April 2025. I know it's confusing, but companies are allowed to have fiscal years that are different than the calendar year. So instead of their year ending December 31st, like the calendar does, their fiscal year ends April 2025 or April 2024. It's confusing. I would prefer this not exist, but it is what it is. Now let's look at its profitability forecast. C3AI is expected to lose 73 cents per share in 2023. That's going to improve to 27 cents per share loss in 2024. And the company is expected to turn the corner on profitability in its fiscal year, which ends April 2026, and earn 3 cents per share. So profitability is a couple of years away for C3AI. At the earliest, it looks like April 2026, when their fiscal year ends 2025. They will be a profitable company on the bottom line. However, there is a long way until that happens, and there are a lot of risks that could stop that from happening between now and then. What I don't like from C3AI is their lack of progress on cash flow from operations. You can see this jagged cash flow from operations and no uptrend here, just up and down and negative for the most part, negative 48.59 million in cash flow from operations in the most recent quarter. They have had a few quarters of positive cash flow from operations. 1, 2, 3, looks like 4 quarters of positive cash flow from operations over the last 4 years or so. So no real positive trend and no real consistency from C3AI and cash flow from operations. Similarly, C3AI has not demonstrated economies in scale. Economies in scale is one of the most desirable characteristics you can find in an investment. In the example I have created here, sales grow from 100 in year 1 to $115.76 in year 4, while net income more than doubles from $4.50 to $9.47 in year 4. This company demonstrates economies in scale. As its revenue grows, its profits grow by a larger magnitude. Not every company can achieve this kind of effective growth. Here's how it works. This is a typical categorization of an income statement of a publicly traded company. Cost of goods sold is what's called a variable expense. That means cost of goods sold is connected to sales. Other expenses like interest, general and admin, and depreciation are not connected to sales. You can see here depreciation stays the same at 25 whether sales increase or not. The same is true for interest expense. It stays the same whether sales grows or not. You can understand your interest payments do not increase when your sales increase. Overall, businesses typically have a mixture of fixed expenses that are unrelated to sales and variable expenses that are. When sales increase, the business leverages those fixed expenses, as we see in this example, and profits grow by a larger magnitude than the increase in sales. That being said, look at C3AI's operating profit margin over the trailing 12 months from around negative 50% and improving slightly in 2021 to falling dramatically and hitting negative 105% in its most recent update. So, no evidence, in fact, reverse evidence of economies in scale. C3AI is actually demonstrating diseconomies in scale. The thing you absolutely don't want to see in an investment, right? You can have economies in scale, or you can have the absence of economies in scale, or you can have the opposite of economies in scale, which is what C3AI is demonstrating. It's losing more money at a faster rate the more it's growing. Thankfully, C3AI has a pristine balance sheet, 762 million in cash and short-term investments, and zero debt. And so while it is losing money on the bottom line, while it is losing cash flow on a quarterly basis most of the time, it has plenty of cash to fund itself for the next couple of years when it is expected to hit profitability sometime in fiscal year 2025, which ends like we saw in April of 2026 for C3AI. And finally, I wanted to look at valuation. C3AI is trading at a forward price to sales ratio of 10.6, which is extremely expensive for a stock of its characteristics. There was few things to like about C3AI looking at its financial metrics. The one thing to really like is the pristine balance sheet. The revenue growth is solid as well. The fact that it recently launched an AI product that's gaining traction with its clients, and the fact that it's forecast to generate profitability in a couple of years. Although everything else, we saw the cash flow from operations, no positive consistency there and no positive trend. And we saw the diseconomies in scale in operating profit margin. So this is not a stock I would be willing to pay anywhere near a forward price to sales ratio of 10.6. So no, I don't think C3AI stock is a buy for 2024. I think it has at least 3 quarters to go before I can consider upgrading that recommendation. I think it needs to deliver a 2 or 3 quarter consecutive streak of improving those trends in cash flow from operations and in operating profit margin before I can reconsider this investment, especially at these valuations. If you liked the video you just saw and you want to see more just like it, please subscribe to the channel. I can't keep this channel free without the support of viewers like you. And if you're already subscribed, thank you, and I appreciate your support.